And welcome back, everyone. For those of you that have joined us from the roundtable sessions, this session is all about domestic capital unlocked. Now, as we know, our continent has massive infrastructure needs and gaps that can be financed by our domestic resources. Yet currently, only 5%, well, less than 5% of that is deployed in our local infrastructure gaps. This conversation is all about unlocking that and understanding where the bottlenecks are and also where the opportunities are. To lead us and set the scene, it is my absolute pleasure to welcome to stage Dr. Vera Songwe, founder and chair of the Liquidity and Sustainability Facility, to give us our scene setter on domestic resource mobilization through greater liquidity. Ladies and gentlemen, a very big round of applause.
Hello. Good afternoon. Can you hear me? Yes. I'm getting a comeback. Okay. So the title of the talk is Unlocking Africa's Domestic Capital. We've just been listening. I should go to the other one? Okay. Can you hear me now? Okay, that's better. Thank you. Good afternoon. We've just come back from lunch. So I'm going to have you play with a few numbers just to wake us up a little bit. I think we've been hearing all day about the fantastic news. Alain is not here. I'm just saying this so that I can record it. That Africa 50 has done an incredible amount of work trying to ensure that we begin to upgrade Africa's infrastructure. But we all know that infrastructure is a big part of our development challenge. We heard also from President Kabaruka, the comparison between Africa and Vietnam, or African countries, because Vietnam is a country, and where Africa is today. But there's another thing that is, I think, part of the constraint that Africa is facing, and that essentially is the case that I want to make to you, is that Africa's financial market infrastructure is lacking. And just to start, I wanted to start with a few numbers. I hope you can see it a little bit better than I can from here. But Africa's GDP is 2.5% of global GDP. So you will expect at least that our capital markets should be 2.5% of global capital markets, or maybe somewhere in that order of magnitude. But if you think about our corporate bond market, it is essentially not even up to 1%. It is 1/10 of 1% of the global capital markets. So just maybe a little math game. What is 1/10 of 1% of 1,000? If somebody threw a number, 1/10 of 1% of 1,000, as old as one, exactly. So if you imagine that the global capital markets were $1,000, Africa is $1. So it's what you leave. It's not even up to your tip, right? The tip is at least 15%. So you can actually lose it and not even realize that you've lost it. That is the scale and size of Africa's capital market. And essentially, it is a market that really has never formed. Next slide, please. One of the reasons why we're struggling with that is that if you look at Africa's particularly corporate bond market, so this is a slide of Africa's loans, and I don't know if Jeremy is in the room or the bankers. Some of them are going to be on stage with me. The green is the loans, and the blue is the corporate bond market. So it's the capital markets activity. And if you look at it, what is actually unfortunate is that corporate markets issuances have actually come down So the issuance amounts are what you see on your left-hand side, and the blue line is issuance of financial market corporate bonds. And as you can see, 2000, it went up in 2004, and then it started collapsing, and by 2024, you could almost not see it. The same thing with the outstanding. Our outstanding corporate debt levels, corporate financial market issuances have totally collapsed. So it's not a market that is growing. It's a market that it's not even taking off and has not come of its own. It's not come to life yet. And this is what I want to argue is part of the problem with the financing of domestic capital. It's not that we don't have the capital. As we can see, bank lending issuances have come down some as well, but they're still relatively high. Next slide, please. So what is happening is that even though we have resources, and this slide is going to tell you a little bit about that. I use slides and numbers because it's after lunch, so you can wake up a little bit. But this slide is about pension allocations. It's a slide that was done with some work from the African Finance Corporation. And what it shows you, and we just had, for those of you who were at lunch with us today, at the post-lunch discussion, is what do, maybe we start looking from the bottom. If you look at the last two, we have India, and then you have global OECD. And if you look at India, the orange number, which is the funds, and other listed 23%, if you can see the orange number. Essentially, what it shows you is what other country pension funds and insurance companies do with their assets and the way they distribute them. And so a country like India allocates almost 23% of its pension assets to equities and to the corporate market. So they're actually investing in their corporate sector. However, when you look at Africa, you look at Ghana, you look at Nigeria, you look at Uganda, um, Tanzania, we are somewhere in the order of 63. Actually, Ghana takes the credit with 83%, if you want to give it credit, Uganda with 78, is in government securities. So it's not that Africa doesn't have domestic capital. It's just we are not putting it to productive use. And in most countries, pension funds and sovereign wealth funds are the ones that actually, invest in the infrastructure, invest in, we just came from talking about asset recycling. They're the ones that do those kinds of investments. On the continent, a lot of our pension funds, a lot of our insurance companies are just buying government securities, and they are not then contributing to global development. And so it's not that we don't have the institutions. A lot of us have written and have heard and have sat in rooms where they've said Africa doesn't save. It's not that we don't save, we're saving. Clearly, the pension funds have all those resources, but it's just the instruments uh, in which the pension funds can invest, or the decisions to invest are not being made. And so that's where we have the rupture, in some sense, on the continent, clearly. And what does this tell us? This tells us essentially that there is a problem with the risk. And I did some work 3 months ago. We had the International Economics Association conference in Belgrade. And I was working on some data because I work a lot with Latin America and Eastern European countries. And we were working on sort of the cost of credit, and is African credit overpriced, and are we being punished, or is there a perception risk for Africa? And yes, there is, but it's not that much. And so I'm doing some work which is technical, so I'm not going to present it, but I'm just going to show you the results, which begin to give you a little bit of a reason on top of what you just showed about what is happening. Is that essentially what is happening is that if you abstract for everything else, so like for like, you take all countries, Latin American, Asian, and African, that are all rated Bs. So they're all rated Bs by the rating agencies. There is no difference. And you say, what happens in a time of crisis or in a time of stress with those countries? Because you want to see how markets react, right? And to see whether markets react differently to Africa versus the others, like, for the same event, what happens. And what we see is that for COVID, for example, which is the red line is Africa and Africa's cost of money, and the blue is Latin America and Latin America's cost of money. And so I run it for the same events. And so if you look at for COVID, I start with COVID in 2020. And if you see for COVID in 2020, there is the same reaction to Africa as to Latin America. The markets react to all B-rated countries in the same way. Price hike, cost of borrowing goes up. Then you take a different kind of market event, which is the stagflation of 2022. And what you see during the stagflation of 2022 is Africa's spike is much higher. That is because of the uncertainty of the risk and the fear that people don't know how to get off Africa's markets. There is no direct exit route. When you invest in Africa, even in Africa's sovereign bond paper, exit is difficult. And so you see that there is a difference between how they react to Latin America and how they react to Africa. The same thing with the Iran-Iraq war, 2025, 2026. Again, you see the cost of money for Africa goes up immediately, whereas the cost of money for Latin America stays the same. So there is something more than just people don't like us, because all of these countries are rated B by the rating agencies. And so you start asking yourself, what is the next slide that the market is looking for? And why do we see this differentiation in cost of money? And essentially, the markets are reacting to us like our pension funds, our own pension funds are reacting to us. They are saying, we don't trust these markets enough because the markets don't have the right infrastructure. So we are going to cost the risk of the unknown or the lack of information, almost like, so what our pension funds do on the continent to us is what global investors do to us as well. And so as you can see, the spread, like for Africa, Latin America, and Asia, we're paying 346 basis points. Asia is paying 77 basis points, even though we have 8,000 projects that have been reviewed by Moody's, and the African default rate is 1.9. We have the lowest default rate. But our own pension funds don't invest in us. So why should somebody else do? And if somebody else does, then that person has to then require a premium for doing it. And hence, we see that premium coming up. And next slide. And why do we see this premium? We see this premium essentially, I'm making the argument that we don't have the basic market infrastructure to be able to invest on the continent. And even when we have, and it's not that we don't have the assets to invest in, and we just came, next slide, we just came from a conversation with a group of bankers, and some of you were there, on asset recycling, where we were talking about how one can recycle, yes, that slide. So essentially, in other countries, one of the reasons why the cost of money is low is because they're already doing some of these kinds of things. They are investing, their pension funds, their insurance companies are already investing in recycled assets. So there's assets that that the government has put up where private investors, I think we've all read, Brookfield is managing the airport in some of the airports in Brazil, or other KKR is managing some assets. So you have marquee, you know, high-grade investment firms that we all know about that are picking up, you know, really prized assets in countries and managing them. They are not buying the asset; they are just managing the asset. And I think it's a very important point. And we've seen this sort of asset management happen across the world, from India to Australia to Brazil to the Philippines, where in the Philippines, the case is quite interesting. I used to live and work in the Philippines, where essentially when the Philippines, when they recycle their energy assets, you bid on how much tax you're going to pay to the government. And the bids sometimes can go from, you know, almost 100% of extra government revenue to 150%. That's how much more a private sector can do better than the government. As we all know, on the continent, almost all of our utilities are not performing. Energy utilities, water utilities, I don't know if it's almost all, but almost all of the energy utilities on the continent are not performing to par. We know that if you put them in private hands, they probably will do much better. And this is what other countries are doing is, yes, you can work with governments to improve utility management, but you can also just contract it out and give 30-year contracts. And with the resources that you use to do that, say in the Philippines, for example, they were able to improve on water management and improve Manila Water. For anybody who knows sort of water management, Manila Water is a marquee investment done by the IFC, by the way. In those days that did it well. So there is some really good stories around asset recycling. And it's a soft way, actually, of a government to begin to work towards encouraging even its pension funds and its insurance companies to invest, because you're investing in government assets, you're investing in assets that you know the nation needs. And so I think the two conversations of asset recycling and how we manage our balance sheets begin to come together in an important way. So why are we not doing enough of this on the continent? Next slide. The issue is fundamentally, so rating agencies, yes, they could do better with Africa, and they're doing much better. Like for like, you would see some differences in the way they rate African countries versus others. But there are things we can do. There is how we develop and build our financial markets that we have not done enough of. And I always give the example of Africans. In 2000, only 2 African markets were going to the capital markets. By 2023, we had 23 of us going. And I give the example of somebody going to buy a Lamborghini when you have roads that are not tarred. Of course, every 2 minutes, your Lamborghini will break down because you have not built the institutions that are needed to continue building. And that's the case in Africa. So in Africa, we don't have any secondary market capital institutions. There is no certainty on, you cannot repo any assets on the continent. It's very difficult. We don't have any standardized legislation around repos. The only market that has, and that's where you see that there is proof to the pudding, is South Africa. If you regress the numbers that I gave you, if you do South Africa, it comes out looking different because South Africa has the financial market infrastructure. Its repo markets work, its netting systems work, so you can essentially cancel out. And these are all legislation, central bank governors that are here, AMFI, our DFIs that are here. These are legislative actions that we can take. If you don't take them, you're just increasing sovereign risk. And as you increase sovereign risk, even domestic capital that we already have, we cannot use to scale. I think this is really the message, is that the onus is not on somebody coming from outside the continent to fix this. This is something within our power that we can fix. And if we fix it, the scale of the resources that we can then begin to bring together is quite impressive. The $4 trillion today, if you imagine that we have $4 trillion and 80% of the $4 trillion is sitting in government bonds. I myself, I spend my days actually trying to recycle government bonds, but we don't even have a market for euro-dollar recycling of African government paper. There is no market for the recycling of African government paper. We have 250 billion of euro bonds, easily recyclable paper, but we cannot recycle it because we don't have the legislation to recycle it, so that even the foreign investors that want to come in, I work with the Abu Dhabi Investment Authority, for example, and they want to recycle, they want to buy African paper, but you can't do it twice, so I've done it once, difficult to do it a second time. IDEA is one of the best insurance companies in the world. So if we are not able to bring those kinds of marquee investors in, on an asset that is so well known, like a Eurobond, how difficult would it be to bring them into an asset that they do not understand, for which they don't know the country is not well rated. And all we need to do is put the legislation in place. And so essentially, I think the plea is here, if we build the plumbing, then we can do the scaling, because we do have the institutions, we haven't connected the plumbing, we do have the assets, we're saving in euro bonds, we're saving in our pension funds on the continent, but we cannot multiply those savings as we do in other developed markets, particularly in the United States. In the United States, you're recycling the same dollar 7 times a day. And in Africa, we cannot. When you enter the African market, you stay, because you cannot exit the market. And if you're getting into a market where you cannot exit, then either you charge very high to enter the market or you never enter. And these are the two choices that we give investors, including our pension funds. And so if we can change that, then I think that we begin to have a much more robust conversation around how we can increase Africa's investments. And then the work of Africa 50 that it is doing so well, which is finding for us bankable projects, I think becomes much easier, because then you begin to find projects that are much cheaper and much more affordable for everybody. We build a yield curve, and hopefully in 5 years when I stand here, we will be able to show that Africa is performing just the same, if not better, than Latin America and Asia in terms of market infrastructure and cost of money as well as development. Thank you very much for your attention.
Thank you very much, Dr. Vera. That so accurately places the emphasis on what we're going to be digesting in this next panel discussion. We will be examining why institutional capital is still only marginally invested in infrastructure. We'll look at how we can make projects more investable, touch into some of the aspects that you just touched upon, how risk should be shared, upon which part of the product life cycle should each investor come in. We'll have representation from pension funds, sovereign funds, the regulators, as well as the private sector. So ladies and gentlemen, please join me in giving a big, warm round of applause as I welcome to stage my panelists, starting with His Excellency Emmanuel Tutuba, Governor of the Bank of Tanzania. A round of applause, ladies and gentlemen. We have Mr. Aminu Umar Sadiq, Chief Executive Officer of the Nigeria Sovereign Investment Authority. A round of applause as he comes to stage. Dr. Jonah Ayabe, Chief Executive Officer of PSSF Kenya. A round of applause as he comes to stage. Dr. Armando Manuel, Chairman of the Board of Directors of Fundo Soberano de Angola. A round of applause as well as he comes to stage. Mr. Dennis Charles Kouassi, Directeur Général of CNPS Côte d'Ivoire. A round of applause as well. And Mr. Jeremy Awori, Group CEO of EcoBank. A round of applause. Now, at the heart of this conversation is a very real tension point. While there's a significant infrastructure financing gap, which we all know of and have been talking about, Africa sits on a ton of money, to put it plainly. There are significant pools of long-term capital available. Pension funds alone are estimated to hold around 1.17 trillion US dollars, and yet only a small portion of that capital is finding its way into our infrastructure projects. It's tempting to say that African institutions simply need to invest more. Tempting and simplistic, as was highlighted in my conversation earlier with Dr. Donald Kaberuka. Pension funds have a responsibility towards protecting the pensions of the contributors. Sovereign funds are managing public capital. Both of these institutions have to manage risk, generate returns, and make sure that the investments meet their mandates. Too often, infrastructure comes with risk: construction risk, political risk, policy risk, currency risk, governance risk, and sometimes all of these risks show up at once. So perhaps the focus should move in a different direction. And we should instead be looking towards how we can create an environment that is conducive and projects that are more investable, that would allow domestic capital to invest in responsively, repeatedly, and at scale. So in starting off, Your Excellency, I'd like to address my first question to you. We often hear that regulation can sometimes be blamed for why much of domestic capital isn't invested in infrastructure. From where you sit, is this the reality, or are we not seeing or producing perhaps enough assets that can be invested in?
Thank you very much, Madam Moderator. And to the outset, I would like to, first of all, to congratulate the Africa 50 for organizing this meeting as they celebrate 10 years of excellence since they were established. And based on the theme that a decade of impact from vision to delivery, I think it is a very topical, which implies the level that all of our African countries, we should align with on it. So for us as a regulator, because I'm working the central bank, you know, there are a lot of issues which we usually undertake because our core mandate, among other things, is to ensure economic stability, price stability, while we also continue to protect our citizens. So like a consumer or those who are transacting through from one place to another. So on our side, usually we have been putting in place a conducive environment that will enable different institutions to flourish or to prosper and continue providing their funds. At the same time, we have an obligation to build up confidence and trust for those who will have money in order to invest in different areas. So even the moment, for example, when we set some regulatory arrangements, for Tanzania, we are also regulating pension funds. And I remember, for example, last week, there's one pension fund wanted to invest in construction of airport in Serengeti. So they submitted their documents. So we set like a threshold of 25% out of their funds because we have an obligation to protect these funds, which have been mobilized or collected from different employees. So under that arrangement, since we have put in place good arrangements and good act or good regulations, they can submit good proposals. Once we go through all those proposals, of course, we gave them an approval because apart from the risk that you have mentioned, there are issues which we need to ensure that we can align ourselves. And once we are through, if we can see that a project is profitable, can have a positive impact to the economy, at the same time, they will be they will be able to mobilize resources, implement their project while they are not suffocating repayment of pensions to shareholders. For us, there's no problem. So under those arrangements, we have been putting in place good regulations which will ensure mobilizing more funds and invest in different areas. We have seen, for example, most of them have been investing in government securities, but we have been insisting even to diversify in other areas. So there are a lot of issues which I think on our side as a regulator, we need also to change our mindset and insist these are pension funds and other institutions to look on long-term areas. I remember as presented by Madam Vera, when we met in Abidjan, during, it was around February, under the guidance of Africa Development Bank, we spoke about coming up with a new financial architecture and looking ahead the way we can mobilize the same funds in different ways in order to scale up and come up with the products which will fit the purposes of our continent. So for us as a regulator, we have continued to come up with a different regulations, and we are most of the time very flexible to the extent that when they come up with a product which will not create more risks to the funds, for us we have no problem. And since we have been updating our regulations from time to time, At the same time, since we are now monitoring economic growth, we understand some risks may come out of our controls, but still we are able to continue looking forward the way we can support their investments to the extent that will generate more revenue while they are remain resilient without maybe put their funds into more risk areas, because you have also an obligation to protect interest of the shareholders. Thank you very much.
Absolutely. Thank you very much, Governor. And I'm hearing an emphasis on the products that are being invested in. And that's where I'd like to direct my next question to you, Mr. Awori. From your perspective, you must see a lot of projects. What is stopping infrastructure projects from being turned into assets that pension and sovereign funds can invest in easily?
Firstly, thank you. I'm glad to be here today. I think there are a number of things. One, in some markets, the regulations, as we've talked about, but regulations alone are not enough, because we've got countries like Nigeria where pension funds can invest up to 15%, for example, in other asset classes, but the investment in infrastructure is less than 1%, right? So it's not a regulatory issue. Part of it is a packaging issue. I think part of it is, I'm trying to think of the best way to put this. Part of this is many investors are used to getting high yields on government securities. And our success is also now created a habit where you just keep investing in high-yielding government securities. Now, the success of central banks, including those here under the stewardship of the governor, is their monetary policies have brought down rates and brought down inflation. So now, essentially, you have to work harder to get a return. So our success, hopefully, will create more incentive to start looking for other asset classes that can be invested in. Now, part of the problem when it comes to pension funds and other funds investing in other asset classes is they have to generate actual returns to pay the pensioners. Now, Africa is blessed that it has a very youthful population, but that's not always going to be the case, right? So the cash flow out is not necessarily as high as it is, say, in Europe. But as we saw from Dr. Vera's presentation, you can see it varies quite a lot in terms of what kind of products are there. And it was quite impressive to see that work. I think there's also an element of education, which is how confident are people to invest in new things that they haven't done before. So am I going to take that chance, or am I going to stay in the safe lane? And what do I have to do to get the approvals to invest in those instruments, even within the bodies themselves, right? The investment committees, the boards that they have to go to. So I don't think it's so much about the products themselves. Yes, some countries will have to do that, but we've seen some countries making progress. I think there are multiple other factors. I think the last one I would talk about maybe is the perception that infrastructure equals government, and government equals political risk. So people are then not necessarily sure, am I comfortable taking that political risk? Now, the asset recycling equation is going to change the perception of that political risk in terms of the management of that asset over 10, 15, 20, 25 years. So I think all these aspects around confidence, perception gap, include communication, education, changes in regulation, packaging, because we need to really mobilize more deposits and encourage retail deposits to invest in funds which can invest in these kind of products.
Absolutely, and that's where guarantees come into play, and we'll talk about that in just a moment. But moving along, I'd like to invite all of you who are perhaps not French-speaking. We will be conducting this panel discussion in a bilingual format. So if you would like a headset, you can signal to one of the ushers that are around. But Monsieur Kouassi, j'aimerais diriger ma prochaine question vers vous. Lorsqu'un projet d'infrastructure arrive devant votre comité d'investissement, quelles sont les raisons qui emmènent à son rejet?
Merci. Je vais commencer avant le rejet. Je vais commencer par le système d'accumulation de richesses par la création de fonds de pension. Je suis dans une zone en Afrique francophone où les habitudes, c'était des régimes de répartition, qui sont des régimes qui ne créent pas d'excédent et qui finissent par avoir des gros déficits. Le gouvernement ivoirien a changé le modèle depuis 2012. Et là où on était tout le temps dans le déficit, depuis 2012, on est dans des excédents. Ce qui fait que notre patrimoine monétaire, financier et immobilier est passé de 168 millions de dollars à 3,4 milliards de dollars. Vous voyez la progression immense. Et depuis cette année, on atteint à peu près 800 millions d'investissements par an. Et quand on se projette d'ici 2030, on va atteindre 7 milliards de dollars et d'ici 2035, 14 milliards de dollars. Vous voyez ce que ça représente comme potentiel d'investissement. Et ça, c'est juste le régime des salariés. Le régime des travailleurs indépendants a été adopté il n'y a pas longtemps. Ce régime aussi va connaître des excédents. Ensuite, le gouvernement est en train d'analyser la possibilité de mettre en place une retraite complémentaire par capitalisation. Donc voilà aussi une autre source de mobilisation d'épargne. Et nous sommes aussi en train de voir avec le gouvernement, les compagnies d'assurance et le fonds de pension que nous sommes, pour instaurer un système obligatoire pour l'assurance vie. C'est pour vous dire que cette capacité de mobilisation de l'épargne locale, elle existe et puis elle peut aller très vite. Il faut la volonté politique et il faut des hommes capables de faire fructifier. Alors, vous avez parlé de rejet. Avant même d'aborder toujours ce point, je vais vous dire qu'est-ce que la vraie sécurité. La vraie sécurité, c'est quand votre portefeuille assure plusieurs années de paiement de prestations. Si vous prenez la CNPS, nous sommes à 6 ans de paiement de prestations. Ça veut dire que si le pays s'arrête, nous pouvons payer 6 ans de prestations. À partir de ce moment-là, vous avez des ressources suffisamment longues pour investir dans des choses qui mobilisent l'argent plus longtemps et même dans des choses qu'on peut considérer comme risquées parce que vous avez un matelas important qui permettra de couvrir tout ce qui va arriver. Alors, notre portefeuille aujourd'hui, côté dividendes, côté plutôt produits financiers, les produits financiers couvrent 32% de nos prestations. Notre objectif, c'est qu'en 2030, ça couvre 50% et en 2050, 100%. Qu'est-ce que ça veut dire? Ça veut dire qu'on va arriver à un niveau tel que d'ici 2050, toutes les cotisations vont être affectées directement à des investissements. Donc voilà ce que je voulais montrer que et il faut que les caisses africaines, les réformes soient faites pour arriver à mobiliser l'épargne locale, bien investir cette épargne, et vous allez voir que les défis vont pouvoir être relevés en partie par les fonds de pension.
Merci beaucoup. Quite a bit in there, but one of the elements that's coming to mind is the different risk levels and at which stage which party comes in. And that's where I'd like to direct my next question to you, Dr. Umar Sadiq. If we accept that not every investor will come in at the same stage, when should sovereign wealth funds come in? Is it an early stage question? Should governments come in early? How do you view this?
just to give context as to how NSIA decided to play this in the context of Nigeria, about 7 years ago, we looked at the amount of assets under management that the NSI was managing relative to the infrastructure deficit in Nigeria. And at best, it was modest. So I think fundamentally, it was important for us to find a way to mobilize local currency, long-term capital towards domestic infrastructure. And pension funds would always prioritize safety before liquidity and then returns. So we decided to create or co-create a monoline insurer called Infra. And it would provide guarantees to bonds issued by infrastructure projects. Upon the default, no questions asked, both interest and principal are repaid, such that pension funds have the comfort to actually purchase those bonds. And in so doing, not only are we mobilizing local currency, we are also deepening the capital markets. And that was actually very, very successful, bar two things. The first was we wanted to make sure that this facility was a capacity provider, not a risk taker. So we were trying to get bankable projects to be financed with, by pension funds, as opposed to having them finance projects that were otherwise unbankable. And that was our first issue, which was projects simply weren't coming through. Well-prepared projects simply weren't coming through. And it was important for us to also find a way of creating a project preparatory facility to ensure that the Pathfinder projects for infra credit to guarantee were coming. That's the first. The second was that if the private sector were left to developing transactions on their own, the scale of those transactions simply couldn't move the needle from a sovereign standpoint. And so it was important for us to find a way, be it through viability gap financing or government participation, to actually augment the financing costs of these projects in order to get these projects to the scale required to move the needle. And then finally, the lack of equity in the capital structure. The inability to finance via equity, particularly for the construction stage, meant that it was hard to get commercial banks into the party. And so what we decided to do alongside the World Bank was to co-create what we're calling InfraGrow, which is an integrated blended finance platform, country platform, that would have 4 verticals: a project preparatory facility, a viability gap facility, a financing facility focused on equity and quasi-equity, and then a large-scale guarantee facility, all working in unison so that we can begin to attack this perennial issue of financing large-scale infrastructure projects.
Thank you very much for giving us light into how you view things. One question that comes to mind for this is, do we then view sovereign wealth funds and pension funds as financiers that come in greenfield versus operational? And I'm going to direct that question to you, Mr. Manuel. How do you view this? Are you comfortable coming in when there's construction risk visible?
Thank you. Thank you very much. First of all, I believe we have to look at what type of sovereign wealth fund we are talking about. Because we have a diverse type of sovereign wealth funds, some that are focused on stabilization, some that have a pure return mandate, others that have focus on national development, and so on. The different structure will play different roles. And I believe it's a point to have each institution getting the right risk at the right time. For instance, the Sovereign Wealth Fund for almost a decade was a traditional savings fund that had the resources placed in international markets and wait for returns over there. A few years ago, we changed the strategy. We expanded the investment allocation classes we brought alternatives into the picture, and we started investing globally. That is where a typical sovereign wealth fund will play a catalytic role. While you have DFIs perhaps stepping in infrastructure, investment, the risking, the sovereign wealth funds can come and push construction, for instance, can bridge commercial and development. For instance, the Angolan sovereign wealth fund put a set aside of few millions for project preparation. Some of the sovereign wealth funds will support project preparation, has a de-risk mechanism as well. On the other side, the sovereign wealth funds, they play credit enhancement role. They have a convening power. One example perhaps that we'll mention here is the fertilizer plant in Angola, urea, where the Angolan sovereign wealth fund stepped in, getting close to 50% equity into the project. Immediately, a number of players came in and provide resources close to $1.5 billion. So we have different roles, but at the end of the day, well, pension funds are long-term investors. Sovereign wealth funds are as well long-term investors. But the point is that sovereign wealth funds can combine both the risking in terms of preparation, supporting development, and can have a catalytic role to push, to ensure that in any circumstances where we have a market failure, we have externalities that block a specific investment infrastructure to be implemented, they step in, they solve that, and they move away, they exit. Thank you.
Thank you so much for giving that clarity. So then my question then is, how important does liquidity become for some players? And I'd like to ask you, Dr. Ayebe, turnover and liquidity, how important is the ability to be able to exit for you? That's one of the things that came out from Dr. Vere's presentation. Is that something that you look at and something that weighs heavily in your evaluation of projects?
Thank you. Thank you very much. I think one thing in context is that pension funds have long-term capital, but what makes this capital not to flow to finance available projects such as infrastructure? One of the key challenges that we see from the pension sector, and more particularly in Kenya, is the ability to match the liquidity requirements of pension scheme with the maturities of these long-term investments. So the way that the assets are being structured to be investable for pension funds speaks a lot. So when it is very easy to say we have a road to construct, we have a utility to make construction for maybe a power line. But for a pension scheme, the board of the trustees and the owners of capital in that case will want to ask themselves the first question: when it is due to pay my liabilities, will I have the liquidity to pay these obligations? So the trustees or the investors, as you are aware, all a very high threshold fiduciary responsibility. On top of it is ability to honor the obligation of paying out pension when it falls due. So this mismatch that do exist within the people who require capital and the providers of capital creates a bit of disjointed way. So there is need to structure the projects or the opportunities into a bankable or investable opportunities that matches the risk level that pension funds would want to take, the liquidity requirements, exit positions, and also the ability to scale. But let's just give it in the context. 10 or 15 years ago, if you look at the pension environment, particularly in Kenya, nobody could even listen to this alternative investment. So let's give credit to where we are at the moment. There is a lot of interest, there is a lot of listening from the trustees and uptake of what is believed to be paying some dividend. But initially, because of the level of understanding, perhaps the way the products were being structured, it used to a very low level. But for now, there is a lot of interest. So if this can be de-risked very well, packaged in a way that there is an exit, maybe a product that can be traded in the secondary market, then things can work out very well for financing infrastructure.
Thank you very much. I'm directing my next question to you, Your Excellency. As we're hearing, infrastructure needs long-term capital. We're talking 15, 20, 25 years. And some, as we've heard, may be reluctant to lock this capital away for that period without a market to be able to sell to. That's one of the key points that is required. How do you view this? What can be put in place to deepen our local markets?
Thank you very much for coming up with this good question. Of course, here in Tanzania, we have already opened the market. We liberalized it fully, our capital market. So we have been receiving investors from across the continent. Of course, for the secondary market as well, we have seen a number of investors coming from different places. And as of recently, I saw one of our local bank, the NMB, who had an opportunity to work closely with the IFC. So they listed in London Stock Exchange. One of the bond, it was 100 million USD, but was listed in Tanzanian shillings. So we understand there has been some challenges that our market is not deep enough. It's still, to some extent, very narrow. But we have opened up to include a lot of people. And, you know, there are different products which we have witnessed. And as of now, for the pension funds and other different investors, there are a number of people or different investors who have came up with some innovations. For example, last financial year, we saw a number of banks came up with the different structures, being for green bond, for example. We also worked with the government of Zanzibar for Sukuku bond. We had other, we call it Jamii, means a social bond, and a lot of them which were also injected in the economy. But when coming up in the economy, for us as a central bank, sometimes they assist us to mop up funds to mop up liquidity, which to some extent will also support containing inflation to remain within the range. So it goes directly in relation to our core function, where, for example, currently our medium-term target in terms of inflation is to contain inflation between 3 to 5%. Now, when inflation is lower, means it also incentivizes other different investors to put their money in different platforms. But when our economy keep growing smoothly, because for last year, for example, our economy grew by 5.9%. Now, this also gives incentives to different investors who want maybe to structure their projects for longer term. So we have seen a number of people or investors coming up with the different packages, and we are lucky that up to this moment, almost most of the banks have been able to structure different bonds, and for us, we have continued to support them. That's why from the beginning, I said that if the issue of flexibility in regulations is very key, because initially, most of the banks or even other investors were used to invest in only liquidity papers. But since we came up with different innovations, we have seen, for example, last time, one of the pension fund even decided to invest in a shoe making factory. Another pension fund has now invested in a sugar factory. So we are now enjoying supply of sugar in Tanzania, but due to funds which were invested from a pension fund. Now, all these in general allow us now to ensure that our capital market continue to be strong and come up with different structures which meet the purposes of maybe individuals, people with a medium sizable funds, and others with a high amount. So every time when we issue like a treasury bond or treasury bills, we have opened up a window specifically for grassroots or small investors. Of course, we created, it goes up to 500 million Tanzanian shillings. And this was designed deliberately to accommodate especially retirees, because initially we saw there are people after being retired, they went to invest in maybe real estate or other areas, but we thought, okay, we can minimize the level of investments in government securities and open up to other individuals, while now lowering the level of investments for pension funds from 80%, currently now is 75% threshold, in order to create a room and come up with the other innovations where they can invest in different projects, especially for longer term projects. But we are now encouraging them to invest by using Tanzanian shilling, which means a local shilling, local currency, instead of hedging in foreign currencies. Because based on the currency risk, since we have a stable economic growth and a low inflation rate, we have given them an opportunity to continue investing in that area, despite that when there are any sort of risks, we can sit together and deliberate on it and see how best we can maybe support them in order to protect the value of their investments. Yeah, thank you.
Thank you, Governor. Those are very tangible examples that we're quite enjoying hearing from. And I'd like to get more take on the real economy, the real market, and just what you're seeing on the ground, Mr. Awori, in terms of productization and products that have been created that can scale and be brought to different countries.
We've seen Dr. Vera showed some examples. I think Kenya, has made a lot of progress in the different types of products. I think it's early days in terms of for the rest of the continent, in terms of what are investable in a way, and what people are comfortable doing. So really, I think, we're talking here about infrastructure bonds. We've tended to see those coming in with their own tax advantages, which makes them attractive both locally and from a foreign perspective. So that definitely works. We've seen longer term bonds obviously being attractive because of the yields. I think we're also seeing real estate, almost like rates being attractive. But it varies quite a lot across the continent in terms of the level of sophistication and the keenness to invest in these instruments. Because not all these instruments should be invested by all classes of investors. And when we look from a foreign perspective, in terms of foreign investors coming in, the issue is scale. They don't want to come in for small sums of money. It's just not worth. If they're coming in for 50 million, 100 million, it just doesn't work. We've just recently gone and listed the first of its kind nature bond on the LSE. If you're not above 500 million, it's small, the 500 million US dollars, right? So we've got to think about this. If we want to attract pools of funds, then there has to be the scale that will come in. So that's really been the experience. I think it's still very, very nascent, but I think, like I said earlier, once the yields start coming down on the risk-free instruments, then people have to think harder, because if you're used to getting 12, 15, 18, 20%, and now you're getting 2%, or 3% or 4%, now you have to start thinking, right? And that can be good because you start investing in businesses as opposed to just looking at just investing in government securities.
Excellent. Thank you so much. I want to go back to the point of guarantees and just see where DFIs should be risk sharing. Like, where does that fit in? And I want to bring you in, Mr. Umar Sadiq. How do you view this?
Thank you. So I think DFI's participation is in the co-creation of guarantee propositions in and of themselves. I think in terms of the conceptualization, development, operationalization, ensuring they get rated adequately to be able to guarantee bonds, I think that is the first. The second is co-guaranteeing, because the balance sheets of these guarantee facilities, particularly at inception, are so small, such that some kind of risk-sharing mechanism is also very, very important. The third is around first loss. So at the project level themselves, it's also important to bring in the expertise, the convening power of DFIs in order to make projects themselves bankable for the guarantors to participate. And I think lastly, for me, it's in the deepening of the capital markets. I think that's also very important because liquidity, as I mentioned earlier, is very, very key. Even if instruments are safe, pension funds will still remain very reluctant to participate if it means they're stuck. And so that liquidity creation as well helps. Thanks.
Thank you so much. I'm going to direct my next question to Mr. Kouassi. Y a-t-il un risque que parfois nous cherchons à trop garantir les projets, qu'il n'y ait plus de risque et que cela crée un environnement où en fait Je vais reposer ma question. Quels sont les risques que les investisseurs institutionnels devraient tout simplement être prêts à assumer?
Alors, la gestion du risque, pour nous, il est à deux niveaux. Pour chaque investissement, on a un processus de décision. D'abord, nous saisissons des cabinets extérieurs qui ont de l'expertise, qui font une première analyse. Ensuite, avec la direction financière, la direction des investissements, on fait de l'analyse. Ensuite, au niveau du conseil d'administration, il y a un comité d'investissement qui lui aussi fait son analyse. Et enfin, le conseil d'administration prend la décision. Quand vous avez un processus comme ça, c'est sûr qu'il y a de fortes chances que les risques soient atténués. Donc ça, c'est un premier niveau. Le deuxième niveau, c'est par rapport au portefeuille global. Le portefeuille doit être varié. Ensuite, nous faisons en sorte de ne pas dépasser 25% quand nous prenons des parts dans une entreprise. De sorte que, au lieu d'avoir, par exemple, 100% d'une banque, on va avoir 25% de 4 banques. Vous voyez que là aussi, c'est une autre façon de réduire les risques. Mais en même temps aussi, il faut se dire qu'en Afrique, on est trop hésitant. On parle trop des risques. Nous, quand on a commencé à investir, on a entendu parler beaucoup de risques. Mais on a gagné beaucoup d'argent parce que c'est dans l'investissement qu'on s'enrichit. Donc, et l'Afrique, comme je disais, les 50 prochaines années, le développement va se faire en Afrique. Donc, il faut que nous, on soit présents. Je dis toujours, ça se fera avec ou sans nous. Mais pour que ça se fasse avec nous, il faut qu'on développe notre capacité financière pour pouvoir nous associer à des investisseurs étrangers qui viendront. Parce qu'ils viendront, puisque la croissance est ici. Donc, si on n'est pas suffisamment prêt pour ce rendez-vous, on va encore rater un rendez-vous de l'histoire. Alors que Quand on prend les fonds de pension, quand on prend les fonds d'investissement, les banques de développement, les banques commerciales, les compagnies d'assurance dont j'ai parlé, si on fait des co-investissements, on se regroupe pour régler le problème de taille. Et je dis toujours, nos pays sont de taille trop petite. Donc il faut qu'on commence à investir en tant qu'Africains et faire des développements en tant qu'Africains. C'est comme ça que nous allons répondre au rendez-vous de la croissance future qui va se faire en Afrique.
Thank you so much. And now, bouncing back on what you've just said and Dr. Vera's earlier presentation, we're seeing default rates among the lowest. And yet, despite that, global capital as well as local capital is looking at our markets and our projects as risky assets. How do we counteract that? I mean, we've heard Mr. Kwasi talk about co-investment and being ready for that. My question is to you, Mr. Manuel. How do we make sure that our institutions are ready for the moment that we're in?
Thank you very much. I definitely echo my colleagues, and going back to the point that Dr. Vera presented here, definitively there is this space for much regulation. But I believe the key constraint is still associated with the lack of bankable initiatives, because pension funds, they look for predictable cash flow returns. If we have a pipeline of good projects, well prepared, definitively they see the money. This is the first point. I'll go back to the pipeline, to the preparation, to the bankability. What we have are many ideas, but not a really financial model ideas. Second, let me talk about sovereign wealth funds, because this is a question of setting up the ecosystem where we bring all the players and having every player doing the right role. If we look to the first generation sovereign wealth funds, are funds that have balance sheet in foreign currency, hard currency, endowed with export proceeds. And by the Bible of sovereign wealth funds, the Santiago rules, the first mandate that they have to take care is to preserve the capital. They have to maintain the capital. If they invest in economy with the currency facing high volatility, if they invest in a project with the proceeds in local currency, immediately they are opening the hand to destroy the balance sheet. That is where we need to start thinking on an ecosystem where we can bring all the players. We need to have the issuances regularly. We need to bring the rating agencies to bring confidence, because you don't build the confidence in the market with an isolated flagship project. You bring a confidence with a consistency. I mentioned yesterday, my dream is to see, perhaps this is assignment for our good institution, Africa 50 and other champions, to see a sort of Pan-African local currency facility that can be backed by DFIs, by sovereign wealth funds. Perhaps pensions funds may come as well, but a sort of facility that provides liquidity support, that provides long-term currency hedging, that provides credit, partial credit guarantee, all packed together. This is a perfect instrument that sovereign wealth funds that have money outside of the continent can see the money into the continent without any constraint. is just one example. I mean, I believe the idea is to look on an ecosystem where we have all the players doing the role in order to deepen our domestic financial markets. Because it's all about confidence. Allow me to give one reference. Has the sovereign wealth fund of Angola figures today, we do only co-invest alongside other private investors. We have a factor of mobilizing $4.9 on each dollar spent by our balance sheet. But this is all about trust. You don't put the money where you don't have a trust. Thank you.
Thank you very much. I'm sure that that is something that has been well received and heard by all of us here, the domestic capital facility, and something definitely worth exploring in deeper lens. Now, bringing my next question to you, Mr. Ayabe, my apologies, as we wrap up the conversation. We've talked about how infrastructure allocation is long-term, and yet sovereign capital pension funds need to have certain guarantees of revenue on the regular basis. Looking forward with some of the ideas and the products that have been floated in this conversation, what do you think is the one action that should be taken over the next couple of years to significantly make a change?
I think I will borrow from what my colleague did mention. First of all, there is need to have a unified, single focus ecosystem where those who are sourcing capital understand the providers of capital to the extent that there is no mismatch on expectation versus the fundraisers, so to say. So one of the key things that needs to come is we need an element of maybe the government or the DFIs to do the de-risking of these projects. So one of the fundamental things is who is going to take the first loss in the risk profile. And in this case, governments should come in to provide that. Then the level of tolerance of risk for pension funds, which is a little bit, they take a higher level, that they are not willing to take a very high level. They take in the kind of senior debt in the profile of ranking of risk, which has been de-risked by government because they are able to accommodate some level of risk, and the DFI can come in at the second level, whereas now pension funds comes in. So we need to have structures that provides a blended financial system, as opposed to just targeting the pension schemes, because ultimately they have the fiduciary and first level responsibility of preserving savings and preserving funds for the members. But having said that, another critical thing that needs is a transformation and a paradigm shift from also the owners of capital, who are the trustees. Scale can only be achieved if the owners of capital, who are the pension schemes, move from purely saving, or rather preserving capital for members, to also be part of the investors or builders in the infrastructure space. So a capacity building comes in or kicks in so that at least they can understand their role beyond preservation, and which sometimes triggers some bit of fear to take a risk, which ordinarily could shape the transformation of capital generation and project development in Africa. So there's still an opportunity, but there is work that needs to be done. Thank you.
Excellent. Thank you so, so much. Now, in closing up, I'd like to give you, Your Excellency, the opportunity of giving your closing statement. Thank you.
Thank you very much. As we close this session, I think from the regulatory perspective, the most critical issue is on governance, because under governance, that's where everything would be put in place to ensure if there are a number of investors, they can invest with a high confidence. But under governance, we have an obligation to strike a balance between maybe investors and those who will benefit from those projects. So from the regulatory point, I think governance is key to ensure that everyone can benefit from these investments. As we come up with a new financial architecture, we have an obligation to think on how best we can utilize our own resources to put in good structures that will be beneficial to all of us to support our long-term investments and the support development of our countries. Thank you very much.
Excellent. Thank you so much. And thank you to my entire panel. Ladies and gentlemen, please give them a big round of applause. This was the panel on unlocking domestic capital. Thank you very much. I'd like to invite you all to take to center stage for a family photo. And I would also like to call back Dr. Vera Songwe to also join our family photo. You can take to the center here. Thank you very much. Now, before you all leave here in the audience, we do have a question to ask you, which is coming up on the screen right now. In just one word, describe how you felt about today's session. You can scan the QR code and we'll just see some of the answers here pop up on the screen. Very insightful, determined, intrigued, hopeful, more heat than light. Okay. Powerful, ecstatic, very insightful again, powerful, positive, enlightening, hopeful. Lots of positive sentiment here. Useful, awesome, impactful yet again, reassuring. Some more coming through. Intrigued again, timely, excellent, exciting, informative, insightful. Now you can see with the size of the words, it's how many times it's popped up. So insightful has definitely been one of the strong sentiments shared in today's session. And the good news is that it doesn't end here. We'll be continuing with day 2 from tomorrow. We're looking forward to seeing all of you. There is a cultural evening taking place this evening, and I believe that all of you who have received the invitation have received the information concerning that with your respective delegations. And other than that, I'd like to wish you all a very good evening. Thank you.